Are you worried about saving for higher education for your child? Let's talk about some good ways to tackle this problem. First, save in accounts that aren't in the name of your child. Applications for financial aid for higher education compute all money in your child's name as being available entirely for college. Only part of the money in your name is counted as being available for that purpose. Second, start saving for the purpose when your child is born. Family and friends may send gifts of money. Get them in that account earmarked for college right away. Tip, please subscribe to the Aspire to Money channel for more great money advice. Third, take advantage of U.S. federal tax laws to save in tax-advantaged vehicles, meaning you don't pay taxes on the increase in value during the saving period or when you withdraw to pay for education if you follow the rules. For example, Coverdell education savings accounts. If your income is below $220,000 for married couples filing joint tax returns in 2019, then this is one college savings vehicle to use. Note, joint incomes between $190,000 and $220,000 have a phasing out of the maximum contribution. Withdrawals are tax-free when used for education. However, the annual maximum contribution for a Coverdell account is $2,000. The Coverdell is attractive because A, it can be used for K through 12 expenses as well as higher education, and B, you can self-direct the investments just as in your IRA. Another example are 529 savings plans. We won't discuss 529 prepaid tuition plans, which are only available in a very few states and in being phased out in most of those. 529 plans are state-run. They generally offer a variety of investment fund choices, similar to what you have in a 401k. Withdrawals are tax-free when used for higher education. The main advantage of the 529 savings plans are that they have high contribution limits. You need to check the rules in your state for any limits on contributions to 529 plans. For example, in California, there is no annual limit on contributions, but contributions in excess of the annual gift tax exclusion of $15,000 per beneficiary may be subject to gift taxes if the contributor doesn't elect to use the 5-year gift tax averaging rule. There is also a limit when the total of all California accounts for one beneficiary reaches $475,000. So be sure to seek advice from your tax preparer for your particular situation. You won't be able to deduct your contributions to either of these plans on your federal tax return. However, in a few states, you can deduct contributions to your state's 529 savings plan on your state income tax return. Make sure the 529 is owned by a parent or a grandparent and not owned by the child. It is for the benefit of the child, but not owned by the child. You are allowed to change the name of the beneficiary of the 529 account so that you can handle situations such as a child not pursuing some form of higher education. Fourth, have your child participate in contests and similar activities from a very young age. Everything from poster contests to exhibiting at the county fair. Many of these activities have monetary awards which can be dedicated to college. Once your child is a high school student, even more of these opportunities become available. Don't overlook any of these. For example, many VFW posts participate in the Voice of Democracy competition, which has high national awards. But even at the post level may offer prizes worth a couple $100s for the top 4 students. Also, keep in mind that many local scholarships are offered by credit unions, banks, utilities, charitable organizations, and other such companies. Fifth, have your child start doing something to earn money starting in elementary school. Lemonade stands, shoveling snow, raking leaves, and many other opportunities are available in your neighborhood. Besides raising money for higher education, this will also help your child learn important entrepreneurial skills. Check out Aspire to Money's YouTube episodes on kids starting businesses for more great tips on this subject. Sixth, consider whether 2 years at a local community college may help your family afford higher education. Seventh, before high school starts for your child, review with your tax professional your asset allocation to see if you should make some changes to improve your family's opportunity of receiving financial aid. Each college looks at financial resources very differently, but they typically don't expect the family to sell its primary home. But if you take equity out of your home and put it in an investment, the schools will look at that investment as being something that you should tap to pay for your child's education. So this is a very important area. Get professional help to do a careful analysis of your situation. Please like, comment, share, and subscribe to the Aspire to Money channel.